In this recording, we're going to focus on Summary 18 question 3, which is particularly looking at ratios, but in the context of capital structure. This is a very common question where essentially you're given a situation where a company is looking to raise finance and they're not sure whether they're going to raise them in the form of debt, in this case new loan notes, or in the form of equity in the case of ordinary shares. And what they want to know is what impact each new funding structure would have on key ratios. Quite popular and covered a lot in the ratios questions, but also recapped in your capital structure session as well. So 20 marks for Summary 18. And what you're looking at here is calculate the current EPS and the current gearing ratio. And they tell you the formula of the gearing, debt over equity. Then they want you to calculate the revised earnings per share and revised gearing, assuming it raises debt, 7% loans, or assuming it raises new equity. So essentially looking at that capital structure decision to figure out what impact does that have on key ratios. And then discuss based on B, which one would be preferable. So essentially come to a conclusion. So you have there 5 plus 9, 14 marks. But what I want you to start looking at is look at the last 6 marks. Outline 4 factors that would impact the rate of interest Nadell would pay in its loans, and discuss 2 key differences between ordinary share capital and preference share capital. Now, if you were a savvy student, you could answer part D and E first, get marks on the board, and then go on to part A, B, and C. Now, A, B, and C are linked together. You have to do them together, but you could easily get some low-hanging fruit by getting those part D and E done because they don't link to other parts of the question. So be savvy in the exam, and then if you run out of time, at least you'll have found some marks on the board. Whereas if you start here, get lost in your calculations, you won't get time to do your 4 or 6 marks here. So you'll lose out on them completely. Just bear that in mind. So you can pause it now, have a read through the question, and maybe make an attempt at what's going on. You're told here Nadell is a company, profit before interest and tax, otherwise known as operating profit. That's a word for profit before interest and tax, 12 million. You're told they're looking to invest 25 million, and they're hoping then that will increase profit before interest and tax to 20%. And they're not sure whether to raise it in debt or raise it in equity. So the first thing we're going to do is calculate the current position. So I'm going to look at part A here, the current position, and you have earnings per share and you have gearing. Right? So make sure, remember, you won't be given the formulas in the day of the exam for these. You are given other formula in a formula sheet, but you're not given any ratios. So you need to know these off by heart going in. So your earnings per share here, just be careful what the formula is. Earnings per share is profit after tax divided the number of ordinary shares. So it's nothing to do with preference shares, you strip them out, but it's profit after tax. So if we come to here, we have profit before interest and tax. You're given that in the question is 12 million. So I'm just going to drop the last 3 zeros to make it neater. You can do full numbers if you want. But in these style questions, the trick is you have to figure out what interest is. That gets you profit before tax, and then you figure out what tax is, which gets you profit after tax. So you actually have to work out what they are based on information that's given in the question. And these are very similar to the questions that have gone before. Have a look at your ratios question pack. There's at least 2 or 3 of them in there. The interest in the current position, they currently have 10% loans at 6 million. So that means there's 600 of interest each year in the current position, which is 10 million times 6%. That means your profit before tax is 11.4 million. And your tax, you're told, is 20%. Times 0.2. And that should be a minus. So your profit after tax here is 9.12 million. 9.12. So what a lot of students will have done is taken that 9.12, divide by the number of shares. The trick is here, and what you should have a little summary cheat sheet is, if there's preference shares, you need to take off the preference dividend. So before you calculate the earnings per share, you must figure out what earnings are available to shareholders. The preference dividend is not available to ordinary shareholders, and that preference dividend is going to be 5% of 4 million. So you're looking at the current capital structure. So that means what's actually available to ordinary shareholders, that is profit available to ordinary shareholders. that is 8.9 million. So that is what you're going to put as the top of your formula, 8920. And we'll put it in the full millions because you're going to put the full number of ordinary shares. Ordinary share capital is 20 million euro and €1 per share, which means you have 20 million shares. So 8920 divided by 20 million. Your current earnings per share is 0.45, 45 cents per share. Now that was quite tricky to make sure, where you go 44.6. First thing was you had to calculate your interest. Second thing is you remember to take off the preference dividend. Third thing was to get the ordinary number of ordinary shares. So for example, if that said 50 cents, you'd have 40 million shares. Or if that said €2 per share, you'd only have 10 million shares. So remember, these are euro figures. They're not necessarily the number of shares. You need to know the par value or the nominal value of each share. So that's your first one, is your earnings per share based on the current capital structure. Your gearing, we're told, is debt over equity. So in this case, your debt is 6 million divided by your equity is always ordinary shares plus reserves. Another word for reserves there is retained earnings, divided by 35 million. So there are different formulas given for gearing. Always use the one the examiner tells you. In this case, it will be a percentage. It will be 17.14%. Now, some students may have said, well, what about the preference shares? Well, the examiner didn't mention preference shares here, so you leave them out. They're not technically equity, and they're not technically debt from this perspective. Now, it was a bit of an ambiguous one here, but a lot of students got that wrong because they didn't use the guidance in the question. And the examiner said that when you look at the suggested solution and their feedback. So the current gearing here, you may have learned a different formula. If the examiner gives you a certain formula in the exam, you use that. So it's debt divided by equity. So we now have our baseline, what the current EPS is and what the current gearing is. And we're now going to go to part B, and we're going to look at debt finance. So if we fund the 25 million investment with all debt, what is the earnings per share and gearing going to look like? So it's quite repetitive. You just have to make sure you change the key information. So we bring this down again. Profit before interest and tax, etc. We get rid of the colouring just to make it clear. So first thing is your profit before interest and tax is growing by 20%. Right, so I'll get rid of all those. So it's growing by 20% because you're told that in the question, if they make this investment of 25 million, profit before interest and tax next year will grow by 20%. You're told then they're going to issue 25 million 7% loan notes. So your interest now is going to be 10 million at 6% because you still have the normal debt plus 25 million at 7%. So your interest now will be gone higher. It's now going to be 2.3 million. So by taking on more debt, you have more interest. So your profit before tax is now 12 million and your tax is still 20%. But you see the way you have to redo the calculations now based on the information that's given. If you take on new debt, that's in addition to the existing debt that's there because you're investing that money in new projects. And your profit after tax then will be 9.6 million. But remember, the preference dividend still comes off. Because if you're still calculating the earnings per share, you still have that existing level of preference shares and that existing level of preference dividend. So your earnings per share now will be 9,440 divided by 20 million. So remember, you didn't change the number of shares because you took on all debt. So there's no dilution of control. So in that case here, you still have the same number of shares, but you have a different profit. So your earnings per share, if you take on debt, it's gone up to 0.472. So it's actually increased marginally from the existing. Your gearing then, when you're taking on new debt, your gearing will be the existing debt, which is 10 million. Sorry, the existing sorry, I mixed that up. That should be 6 million times 10%. So you still get the same answer, I just mixed them up. That is your 6 plus your 25 divided by 35. Right, so divided by 35. So it's 31 divided by 35, debt over equity. That's the formula the examiner has given you, so make sure you use the one they've given you. So that is a significant increase in gearing. Your gearing, based on that definition, is now 88%. You're nearly at the same level of debt as you have equity. So it's a significant increase. But that's what you're doing. That's your 3 marks for part B, is you restate the financial statements and then you recalculate the formulas. So we'll do it for C beside it, just to make it easy to compare. So we'll take our issues again. This is all the equity finance now. And we'll do it down. So in our case here, profit before interest and tax is going to be increased by 20% again, because they don't care where you got the 25 million. They just want to know you've invested it. That will increase your profits. Your interest is only going to be 600, which is 6 million times 10%. So just your existing level of debt, because if you're raising all equity finance, your debt level doesn't change. So that means your profit before tax is 13.8 and your tax is 20% again. So your profit after tax is now 11 million. So it's a higher profit after tax, but as you'll see in a second, you're going to have more shareholders because you're going to dilute your control because you've brought in new shares. Preference dividend stays the same because that hasn't moved. So the profit available to ordinary shareholders, which is what earnings per share is based on, is 10,840. And your earnings per share here is 10,840 divided by, just be careful now, you're now issuing new shares at €5 each. This is option 2. So if I want to raise 25 million, I have to issue 5 million new shares. So there's actually going to be 25 million shares. That's an important one that you understand. So previously there was 20 million shares because we issued no new shares. But here we've no extra debt, but we've new shares instead. So there's a dilution of control. And your earnings per share here now, just so we copy the format across, is going to be 0.43. So it's actually small dilution because the increase in profits doesn't cover the increase in the number of shares. So your earnings per share goes down, albeit slightly. And then your gearing. The gearing here now, just be careful with it. Your debt level is still 6 because we didn't take on any new debt. And your equity level, if you go back, your current equity is 35, always looking at ordinary share capital plus reserves, but you add on another 25 million because you've raised 25 million extra equity. So it's now going to be 6/60, which is 10%. So that's a significantly different gearing than if you took on the debt. So much less risk when you take on equity, but you do have dilution of control. You now have new shareholders coming in, and they now own 5 million of the 25 million shares. So they own 1/5 of the business. So there is a dilution of control. So that's your first protocol there for 5 marks, and then for another 6 marks, 11 marks overall, is calculate earnings per share and gearing 3 times. The current one and the revised one, depending on what capital structure decision or funding decision you take. So what you're asked in part C then is, based on your calculations in B, which financing option would be preferable to the shareholders? Now I would always start off by, for your part C, list them out. Your current, the debt option, and the equity option, just to show the examiner that you've done your calculations, but also then that it makes it easier for you to make conclusions as well and comment on them. So the current situation here, 0.446 and 17.14%. Now I'll tidy up these just to make sure. So they are 446 and that's a percentage. I'll just copy those across. So in this case, it was 0.472 for the debt and 0.434 for the equity, and 88.6% and 10%. Just copy those to make sure we use all the same format. So there's no harm doing that because it's nice and neat and you won't make any mistakes. In terms of your commentary then, well, essentially what you're saying is, if you go with the debt, you have an increase in your earnings per share, but you have a significant increase in your gearing. Right, it's going up nearly 7 or 8 times. So that's a huge extra risk that the shareholders may not want to burden. Whereas you're lowering your gearing with the equity, but there is a dilution of control. So again, there can be arguments here, and you could have come down either side. If you wanted to argue, you should have went with the debt, because why? You want no dilution of control, because otherwise you're not giving up anything, and you're getting an increase in EPS. So you might have said that, if you want to go for the debt one. If I was answering it, I would have probably went for the equity to say, equity, you'll have a small decrease in EPS. It's not huge, but less financial risk. So you're not taking on that financial risk, but there is dilution of control, because now you have 20% of your shareholding, 5 million out of 25 million, are now in the ownership of someone else. Right? Or you have to put in the money yourself. So it's a tricky one. Even the suggested solution, when you look at it, they don't come down hard in either one. What you'd want to know is this gearing ratio an outlier? Because remember, the way the gearing ratio is defined here, it's debt over equity. So that doesn't mean that you have 88% of your business financed by debt. It means that debt is 88% of equity. So you nearly have half and half. So to come to a conclusion there, you'd want to know, is that a real outlier in the business? You'd want industry averages. But for 3 marks, you'd want to just come up with your key things. Is there an increase in risk? Is there a decrease in profitability? Is there a dilution of control? They're the 3 key things you're looking for. And you must, as the question asked, link it back to part B. Use your calculations. And remember, that overall now is 5 and 9 is 14 marks. You've roughly just over 1.5 minutes a mark. There's 180 minutes overall, 3 hours to paper, 100 marks. So I always say use a rough guide of 1.5 times 14. You have about 20 minutes to do a question like that, part A, B, and C. Part D and E, then you can have a look at yourself. They're nice questions. Outline 4 factors which impact the interest rate Nadal must pay. Right? And they can be any 4. It's just outline, don't have to go into a level of detail. So what you're looking for there, for example, would be, what's their credit rating? The lower the credit rating, the higher their interest rate. You might look at their current gearing level. The more debt you have, the riskier you are to a bank, so the higher they're going to charge. They're going to look at, for example, what's your credit history? Is your credit rating? Have you dealt with the bank before? Are you a good customer? The size of the loan. Bigger loans usually get lower interest rates because of economies of scale. But also the state of the economy. If you're in a recession or a boom, interest rates from the central bank can drive what interest rate is charged in a company's loan. So you'll see in the solution, they list them out quite clearly, and any of those, just 4 of them, 4 marks. So that's why I said try and make sure you get those easy, low-hanging fruit ones, because they will be very helpful to get marks on the board. And they could have been done first before any calculations. And finally then about sources of finance. 2 key differences between ordinary share capital and preference share capital. So 1 mark for each. First obvious one, ordinary shareholders have voting rights. Preference shareholders do not. Ordinary shareholder dividends are optional. They may or may not be paid. Preference share dividends is usually mandatory. It's paid every year. It's a fixed dividend. Right, so there's plenty of little small ones you can get. See them here. Preference is paid before ordinary. Right, preference share capital is paid in priority. And again, equity shareholders have voting rights. Preference shareholders normally do not. Sometimes they can, but normally they do not. But they are nice 6 marks. You get those marks on the board. You wouldn't need 9 or 10 minutes to get them. And remember, don't overkill. 4 factors, 1 mark each. 2 differences, 1 mark each. So think like the examiner as well. So if you look at the feedback from the examiner that year, what were they happy with, not happy with? Generally answered very poorly. The calculations. Students didn't know how to redo the financial statements. They couldn't get profit after tax. They couldn't deal with what we've done here. Recalculating the new P&L, the impact of interest, the impact of preference dividend. And that's disappointing because this came up in 2013, it came up in 2016, it came up in 2014. So it's not like they were new questions, they were well examined before. All right. And generally then you see here, part D and E, generally well answered. They are the nice little narrative ones. So remember, narrative, that was 6 out of 20 marks. Right, so it's very silly. Don't throw away easy marks in the exam. And if you get the chance to do those first, get the low-hanging fruit. And then worry about the calculations when you build up a bit of confidence. So that was Summer 18, question 3, focused on ratios, but in the context of capital structure decisions. And make sure you go back and look at the ratio question pack, which is at least 2 or 3 other past exam questions of a similar format.